Hey, everybody. How's everybody doing tonight? Yeah, the 6006C from last lecture. Yeah, it's looking good. Just buy a few more, Ant. Yep, it's going to come back for you. Probably by tomorrow, it'll be in the money, I would think. At first, I read that and I was like, what? And then I realized you weren't serious. 43264. 432. Got to get a couple special little levels charted here on a nice clean setup before we get too deep into this one. But we'll give everybody a couple minutes to join, and then we'll get started. 378. In the meantime, how's everybody's day going so far today? Hopefully everybody's feeling decently well.
Yeah.
408-171. Hey, Aaron, good to see you.
Just say hi.
Glad to hear it, Michael. We'll get started in like 2-ish minutes. Just gonna give everybody the chance to hop on in here. We got a fun topic tonight. I think the tone in last lecture is gonna be a little bit different than this one. I skipped last week. I was actually out of town, so I wasn't able to make it to that one. But yeah, this lecture should be a fun one, to say the least. It's a lecture. Last time we gave this lecture was it was all the way back in 2022, 398.6. But we're back. We are back, like it or not. I know, I tried throwing you off a little bit with the 8 p.m. start. I don't know, I might start trying to get lectures started a little bit earlier on these days. I don't know what you guys think. What's your guys' preference? Do you prefer the 9 Eastern or the 8 Eastern? I know for me, I'm in Pacific, so in the past when I would get off work, it was a little bit later, but these days, I think I could swing this earlier time a little bit more often than I have in the past if it's something that you guys all prefer, but we don't have to do it just because I want to. Either works. Either works. Okay, so nobody has too strong of a preference then. Jay likes 9. Okay, too early for Jay. All right, good to know. All right, we're gonna give it just probably another couple minutes, and then probably 1 minute actually, and then we'll get started. I'm just gonna send out one more message letting everybody know we're getting started, and we'll have a party tonight. 5 to 6 Pacific works best for you. Okay. So far, it sounds like 8 Pacific or 8 Eastern is a little bit more preferable. Jay's in the minority right now. All right. Well, we got a lot to cover, so I don't want to waste any more time waiting for other people. So let's get started. Welcome in, everybody. Welcome to the lecture. Last time I gave a lecture was about 2 weeks ago. In that last lecture, I believe what I had said was I was looking for kind of some kind of bounce higher, which kind of never really came, to be honest. I think the last lecture was on this day. Let's see, 325. 325. Yep. So 325 was the last lecture, and I said I was looking for a little bit more bounce, and turns out that that was the absolute dead top. So it was basically completely wrong. I was looking for a little bit more of a move. I think like the 50 simple moving average was what I was looking for there. Let's see. No, yeah, maybe 584 is what I was looking for on that bounce. Anyway, it doesn't matter. I was definitely wrong. And in that last lecture, I was talking a lot about how we can't start calling this a bear market. It is still a pullback until proven otherwise. And it was definitely at that point, and is still a good point now to react to the market rather than be predicting things. Continues to be an excellent market to relax a little bit, size down, not be in crazy large positions. And we're going to talk a little bit about some of the history behind bear markets, talk a little bit about what they mean, because I'm assuming for a lot of you, this is kind of a first time experience. So we'll talk about kind of what a bear market is, kind of how we're trading in the present day, and how to kind of manage risk and identify more higher quality spots to get involved in the marketplace once some of these fundamental conditions resolve. And at least for this bear market, I think it's relatively simple. So let's just start off real quick by defining what a bear market is. In general, a bear market is when a given, typically one of the major market indices, so the S&P, the Qs, or the Dow, declines 20% from their all-time highs. So if we go to the index here, SPX, and we take a look just on recent declines here, the last bear market was in 2022, and we can see from peak to or peak to low, I guess, this one declined about 27%. And it entered a bear market right about here. This was kind of the first touch of that bear market level, and really started to maintain that bear market level with some price action closes below that threshold back in June, all the way back in June 2020. And ultimately, it came back out of that bear market, started making new highs in basically the beginning of 2024. And we all know what has happened since that time, right? The S&P has gone on to advance about 28% since those prior highs. Or did go on to advance that amount, and now has basically given all of that back in a matter of weeks. So that's a technical definition of a bear market. Other people might have different opinions on what a bear market might look like, but if we're going by the book, a bear market is when a given equity declines 20% from its highs. And some people like to say that, they talk about bear markets for individual equities. So like, for example, something like NVIDIA has been in a bear market since it hit this kind of 120 spot after hitting 150, representing a 20% price action decline from these prior highs. For me personally, that's not something that I get too concerned with. I'm more focused on kind of the broader market, but just something to be mindful of, that concept and terminology still applies. So you guys might be wondering why we're having this lecture today, or maybe you're not. And if we take a look at where the S&P is at, it is just starting to flirt with that 20% decline level. And the way that I calculated this, I'll just zoom in a little bit more so we can see a little bit cleanly. So the way that I calculated this is pretty simple. You can see the price action high here of 613.23. You take 613.23 times 0.8, representing a 20% decline. And we get 490.58, which is exactly this level that I have on the chart here, 490.58. And you can see both today and yesterday represented in kind of an opportunity off of this level, but I think that's something that we'll cover a little bit later in the class. But we're trading right at that bear market threshold, which is super significant, right? These sort of levels have a lot of psychological significance. When the market enters a bear market, some people may not be able to invest based on whatever strategies that they're following anymore. Generally speaking, bear markets correspond to a lot of fear and panic in the market. So just because we hit this 20% threshold doesn't mean, okay, we got the bear market. We're going to go right back up to all-time highs. We'll talk a little bit about how a bear market ends. We've had a lot in recent history that we can learn from. And I highlighted just a couple that are going to be the primary focus of tonight. But in short, basically by any definition at this point, the market is either in a bear market or teetering on the edge of one. I think technically we need to see a price action close under this 490.58 level for the S&P to be within a bear market. But the NASDAQ has been in a bear market for a couple days now. So it closed under that 20% threshold last Friday. So the NASDAQ is officially in a bear market. And if we run the same calculation just from scratch on the Dow, I haven't actually done this one yet, so let's just do it together. So we take 451.55, and multiply by zero point 0.8, gives us 361.24. So this one's not quite in a bear market just yet. So I like to mark these levels off, and I just call it 20%. Show that on the right. I make it red because it's real important, and I forget the level already. 361.24. All right. So the Dow is a little bit further away from a bear market at this point, definitely in a correction. So a correction represents a 10% decline from all-time highs, which would have been about 405. So it's entered a correction last Friday, and it's just teetering on the edge of a bear, kind of similar to the S&P. So market is for all intents and purposes either in a bear market or real close to entering one, and more than likely to enter one. You can see the movement in the after hours has us back below this level. That doesn't necessarily mean anything now. And also just real quick, just highlighting the significance of this spot. Notice how well this level is kind of respected both intraday and after hours. It's actually kind of shocking how important these levels truly are. Back in 2022, this was a concept that River put me onto, which was putting these levels on the chart because they are so significant. And you can just see how we've been teetering around this bear market level over the past 2 days on the S&P. Both rejections in after hours, support during market hours, and even right where we bounce at the close today for about a 10-point rally almost into the close. So real significant stuff happens around these levels. So you got to be paying attention to them. And let's talk a little bit about some prior bear markets. Well, I guess before I get into that, any comments or questions so far? Jomo says death cross on the daily for the SPY yesterday. Was it? Death cross is 50 under the 200. I saw the 50 over the 200. I don't have that. I don't know. Maybe it's calculated different for some reason. All right. Well, let's get into the PowerPoint. I don't know. Yeah, sometimes the moving averages get kind of funky. Either way, so this lecture is going to be all about learning from prior bear markets and talking about how these concepts apply to the current bear market. Before I get too deep into the content, I want to stress very clearly that trading in a bear market is not something to take lightly. It's not just like how we've been trading over the last 2 years. It's absolutely a completely fundamentally different environment. And you have to respect that because the market is no longer moving on simply technicals. It's not going to move on bear flags and bull flags. All it's moving on is headlines or data, right? That's it. That's literally all that matters right now. If we get a headline that tariffs are all canceled tomorrow, we're probably going to be back at 550 in the same day. And we saw that headline kind of come in, that rumor yesterday, and it led to a 40-point rally intraday, right? And there was no bull flag or double bottom that led to that, right? It was simply a headline. So the more that you realize that whatever you look at on a chart really doesn't matter except key levels, the better you'll be able to actually trade or not trade, right? So don't do anything super silly. This is absolutely an environment to size down. The last kind of warning that I want to provide is just by taking a quick peek at the VIX here. So again, as we know from the beginner's course series, the VIX represents the volatility index. It's calculated based off of 30-day forward SPX options. So it's like a ratio between the two, a ratio between 30-day SPX put options and SPX call options. And basically, as this index or benchmark rises higher, that essentially means that the market is expecting more and more volatility. And I actually don't know off the top of my head what the expectation for volatility is when the VIX is at 52. Actually, I think generally speaking, you can get pretty close if you divide it by 16. Let's do that, 52 divided by 16. Okay, so let me just back check this really quick. 32. Okay, yeah, I should have been able to do that in my head. So kind of the benchmarks to watch out for on the VIX are generally around 32. That's when the market begins to price in about 2% moves in SPX every single day. Now we're at 52. And again, this is just a crude calculation. It's a reasonably common ratio in the VIX that if you divide the price of the VIX by 16, it approximates the expected move in the SPX on any given day. And right now what the VIX is saying is on average, the SPY or SPX is going to be moving approximately 3% a day. Most of you probably haven't even seen a 3% move outside of these last couple days. And just to kind of note the significance of this, we can even look back on the chart. Some of the biggest moves that we've seen in the last year are maybe here. That was a 2% move. Here, that was about a 1% move. Here, that was about a 1.5% move. This was a big one after Trump got elected. Let's see here. This was a little bit above 2%. So at this point, we are now getting an expectation of 3% moves in any given day. And even if you just take a look at the options chain here for SPY, note the implied volatility that's being priced in. On average, IV on the SPY is closer to this longer term structure here, around 20 to 30%. In the short term, they're pricing these contracts at 96, 71, 90, and 85%, which is basically triple the average implied volatility. And again, connecting back to our beginner's course series, we know that as implied volatility rises, the price of options contracts gets far more expensive. And if we take a look at our same days, those of you who are a little bit more fluent in the pricing of contracts, a 1 day to expiration at the money right now on the SPY is $1,400. Generally speaking, this contract is a lot closer to like $300 to $500. So what does that mean, right? And this is just, again, part of the larger warning that I wanted to provide at the beginning of the lecture. What does that mean? Well, as options traders, our life is pretty simple, right? We're looking to buy contracts at some price and sell them for a higher price. The problem when implied volatility gets high is that when implied volatility drops, we now have two things working against the price of an options contract, right? If IV drops, we have that working against us. And then as time continues to pass, we still have theta working against us. And if you look back at some of the options moves that we've seen recently, let's just take a quick peek just to kind of show you and illustrate how crazy this really is. So in a normal environment, right, basically this, wow, this was a 7% decline intraday, 6.5% decline intraday. In a normal environment, and I don't even have these metrics off the top of my head, but in a normal environment, this is hundreds and hundreds of percents. This is more than 1,000%er. On the SPX, it's probably closer to 10,000% on a same day. And if we take a look at an SPY contract, we'll just look at an at the money. If we take a look at SPY 2504. 0408P. Let's just grab an at the money. Let's just say a 510P. See how that traded throughout today. So let's see how this guy traded. So if we start from the high of day, right around 710, which is right about here, this thing started at 69 cents and it ended the day at 20 cents. Okay, actually, that's kind of a bad example. This is a massive ripper. I'm not going to lie. This is a crazy one. That's 2,800%. All right, I can't act like that's a bad trade. Let's grab a little bit closer to the money because really that was 15 bucks out of the money. So we'll go to a 520. Yeah, that would have been a sick trade. I'm not going to lie. Wow, even this one. This is turning into an advertisement for same days with the VIX at 52. That's 1,000%er. Yeah, I can't really argue with that, honestly. I'm going to stop trying to provide those examples. But fundamentally, options contracts are significantly more expensive now more than ever. Trading options.
Now SPX.
Yeah, exactly, Rob. You got that right. That was a full-blown ad. But yeah, fundamentally, options contracts are significantly more expensive than they normally are. Volatility is significantly higher than it normally is. And these are all things that you have to be mindful of as an options trader. This is not your average market. And the more that you internalize, hopefully the more that you reduce your risk, right? You got to size your positions down because things can change really quick. Today, we got basically a 7% move intraday. Yesterday, we got about the same, a 8% move intraday, right? This is the S&P 500. This thing moves on average maybe 1% a day. And we got basically 7 to 8% moves back to back. It's just not something that happens every day. And you got to be really mindful of that. So with that, let's talk a little bit more about kind of the history of bear markets and how we can learn from them. So starting off, we're going to go all the way back to the 70s, which I would assume the majority of us probably weren't born at this time. But let's talk a little bit about one of the more significant bear markets in the last, we'll say, 50-ish years. So what were some of the fundamental conditions that led to this specific bear market? Well, in general, if you remember, this was right around that kind of oil crisis era, the oil crisis of 1973. So oil prices were very high. Yeah, Rivers era, this is when he was a teenager, actually, believe it or not. He had graduated high school in 1973. So he actually wasn't able to have a car Yeah. Additionally, there was very high interest rates during this time. I believe this was the period of Volcker as the chairman of the Fed. And this was a period where interest rates would fluctuate from 5 to 10%, down to 7%, all within the period of about 1 to 2 years. So a lot of volatility in interest rates being set by the Fed. And additionally, there was really significant inflation. And finally, the dollar was losing value. So again, one thing that I want to call out is 3 out of these 4 conditions should sound very familiar if you were trading anytime in the last 3 years, right? These last 3 items, high interest rates, rising inflation, and a falling dollar, is exactly what happened in 2022. Like the exact 3 conditions, right? Interest rates were high due to the Fed hiking all the way up to about 5.5%. Inflation was high, CPI inflation all the way around 9% at its peak in June of 2024. And the dollar was also falling during that time. So purchasing power of the dollar was falling, inflation was rising, and the interest rates were also high at the time as well. And the reason that I wanted to call this out in specific is because, generally speaking, the premise of these bear markets isn't always unique, right? And there certainly has been some, like for example, COVID was definitely a wild card. But the premise of tariffs leading to bear markets, or at least significant corrections, that's not a new thing. That's happened before. Just looking back to 2018, we had the same thing when Trump tried to announce tariffs the first time around. And just looking back at the charts, let's just zoom out real quick, look back to 2018. You can see what happened, right? This was right around that same time that Trump was announcing tariffs the first time around. I think this was probably the first announcement at the beginning of 2018, and this was closer to the second announcement. And you could see again about a 20% bear during that time as well. So the concept of tariffs is nothing new to the market. So this is the 1973 to 74 bear market. Let's talk about some of the reasons why those fundamental issues happened. So again, we had high oil prices, high rates, rising inflation, and a falling dollar. So at the time, President Nixon was working to resolve inflation. So there was a couple different policies that he enacted in order to accomplish this goal. So the first one was suspending what was called the Bretton Woods system, or what was more commonly referred to as the gold standard. So Bretton Woods basically linked the dollar to gold. It also had some flaws in the policy as well. But at the time, and still today, the dollar was and is the currency of world trade. So basically, as dollar amounts globally increased past the amount of gold that the US had in reserve, that was something that didn't go unnoticed, right? Other countries started to realize that the amount of money that we were printing was really no longer backed by what we had in gold. So no longer was gold backing the United States currency, but rather basically the full faith and credit of the U.S., which is a pinky promise that says, hey, we're big enough to pay you back and secure this investment that you're placing in U.S. dollars. So dollars were basically being converted to gold before Bretton Woods, and Nixon suspended this by getting rid of the Bretton Woods system. So this resulted in extreme devaluation of the dollar, right? Because all of a sudden, the dollar was no longer linked to this high valued asset, which resulted in wage and price freezes, and surcharges or tariffs on imports. And again, the goal was to strengthen the dollar as much as possible, but it just really wasn't working out the way that he had envisioned. So this is what inflation looked like during this period. You could see it made it all the way up to 15% over this time frame, as measured by the CPI. A lot of volatility in inflation during this period as well. Just an incredibly difficult time, really, to be in the United States. Honestly, it definitely wouldn't have been very fun. And here you can see what the Federal Reserve funds rate was doing. So this is back in 1972. We had a rate of 5.5%, which crazy to think about a rate like that being low at the time, considering 5.5 was the absolute peak of rates during our most recent hiking cycle. And you can see from March of 72 to July of 73, Federal Reserve funds rates increased by 5%, which is and still was historically quick. That's a little over a year to increase by 5%, which again was recently beaten by this most current hiking cycle, but still at the time was absolutely crazy. 10% rates, imagine what that would do today. 10% rates would be probably 13 to 14% mortgage rate. It would probably be closer to 40% on credit card APRs, auto loans, probably around 18%. And you can imagine what that would do to the consumer, right? I can speak for probably all of us in the room in saying that I find it very unlikely that a lot of us would want to buy a house when rates were at 7% for mortgages. I can't even imagine on what that might have looked like when rates were above 10%. Especially if that happened in a day like today, it would just it would crush the economy, right? So you could imagine what was going on in the United States throughout this time frame. Yeah, a high yield savings account was killing it. Except the problem is you had so much inflation that you really, while it looked like it was killing it, when you look to inflation, you weren't doing so hot actually. But yeah, I mean the number in the high yield savings account definitely would have been rather lucrative. And again, you can kind of see how volatile this Fed fund rate remained. We had a recession when we hit 10.25% rates. Then we dropped rates back to 9. Then we rehiked back to 13. Then we got a new president. We dropped back to 5.5%. So rates were literally all over the place. There was no clear direction from the Federal Reserve. There was not too much clear direction from the president. And all things considered, the market was incredibly volatile as a result. So taking a look back at historical rates, I provided kind of three boxes here through the period of 74 and 75. And this was when rates basically peaked in this last bear market. So the red box represents kind of the run up, the green box represents the peak, and purple represents the decline in rates. And this was when the Federal Reserve ultimately pivoted and kind of committed to a new stance on monetary policy. And I think this also corresponded to a transition in presidency as well, if I remember correctly. And now comparing this to the chart, right? If we look back at this red box, this was when rates were basically approaching their peak. You can see what the market did. Green box is where rates ended up peaking. You can see the green box marked on the chart. Then comparing the purple box, this is when rates maintained a sustainable decline. And you can see how price reacted as such. And this is very interesting because once we look forward to the bear market of 2022, the scenario was the exact same. And I don't want to foreshadow too much, but this is basically exactly what happened, right? As the Fed continued to hike rates and make money more expensive and basically decrease the power of the consumer, overall, the marketplace dropped, right? Because that results in lower earnings estimates. If consumers don't want to spend as much money, businesses probably don't want to spend as much money. If businesses and consumers don't make money or spend money, then publicly traded companies don't make money. And if they don't make money, there's nothing to return to investors. So why would I buy the stock? So I'll sell the stock, blah, blah, blah. You get the point. So as money becomes more expensive based on these rates, we're seeing the selling in assets. Once those rates topped out, we saw kind of a substantial bottom in the market, which obviously is clear in hindsight, but definitely wasn't in the moment. And then once we saw that sustainable move lower in rates in this purple time frame, that's when we started to see a sustainable move higher in equity prices. And this really sums up the bear market of 73, 74. In general, I think I maybe have a slide on some lessons. Let me see. Yeah, okay. So in general, right, through a period such as this, where rates are literally all over the place, you do have to block out the noise to an extent, right? You can't trust just necessarily the just intraday or day-to-day or week-to-week moves in price or in data. You have to be able to block that out and focus more on longer-term sentiment. And drawing that as a parallel to our current market conditions, right now, the sentiment, at least from the government, and specifically the president, is all related to increasing tariffs, right? And until that specific sentiment changes, you probably shouldn't expect much of a significant long-term bottom. The other lesson that definitely came out of this was follow the Federal Reserve. And this was also another lesson coming out of 2022. Once the Federal Reserve was able to lock in a specific sentiment of lowering rates, that's when the market actually was able to put in that sustainable bottom, right? But until that pivot occurred, there was really no long-term bottom being put in, right? Every single floor that looked like it was being set continued lower once again. And the only time the market actually bottomed was when the Fed truly pivoted, but not only just pivoted, right? Because this was when they really pivoted, rates began to decrease, which we can see in this green box. But we didn't get a sustainable move higher until rates maintained the trend lower, right? So there's kind of two things that we learned here. Number one is, again, those kind of day-to-day or week-to-week data points aren't necessarily relevant, right? You have to be looking more towards trends. And again, driving another example to today, right? Yesterday, we got a rumor that Trump might be taking a step back on tariffs, right? Which is positive. And you might think that, okay, it's time to buy. But we didn't hear that from Trump. We heard that from some random outlet probably. And ultimately, we are now multiple dollars lower from when that headline initially came out. So until there's some sustained and clear change in sentiment directly from the federal government, specifically the president, there's absolutely, positively zero reason to think the bottom is in. Zero reason. All right, let's talk about 2007 to 2009. I'd like to think this is a market that basically every single one of us, at least were alive for. Maybe not all of us were alive enough to comprehend exactly what was going on. But let's talk a little bit about it. So the fundamental conditions that really led to this one started with, oops, one of my bullet points is missing. Started with the housing bubble, right? And a lot of what was driving this was subprime mortgages being lent out in what were called mortgage-backed securities. So basically what was happening is bankers were giving out mortgages to basically anybody and everybody who would apply. People with the worst credit, people with the best credit, it didn't matter. And on top of that, right, that's obviously a problem for one reason, but on top of that, there were what was called mortgage-backed securities being sold, which basically provided a return from the interest payments of that mortgage. At least I think that's how they worked, but I can't remember fully. Anyway, the problem is if those mortgages defaulted or those mortgage payments stopped coming in, then those mortgage-backed securities also stopped getting their money and became worthless as well. So it was kind of a positive feedback loop, right? If people run out of money to pay their mortgage, then not only does the bank not get their money, but also the investors aren't getting their money from the securities that invested in them. So there's a lot of people doing very, very poorly in this specific era. And then also, this was a decades-long situation. This wasn't something that was made in just a single year, but rather this was a significant period of basically cheap money, which all ended up in mortgages. So how exactly did this end up resolving itself? So the first was a bailout of the banks. And what we can see here is a graph of the Federal Reserve's balance sheet, which probably looks a little bit familiar to some of us who have seen this before. And you can see this was where the Federal Reserve basically injected billions and trillions of dollars into banks to keep them afloat. And this was also what could be referred to as starting, oh, wait, never mind. I got that backwards. I don't think the Federal Reserve were the ones that gave the money to the banks. Sorry, I said that incorrectly. The government approved stimulus that was providing money to the banks. The Federal Reserve started quantitative easing, which basically meant that they started purchasing assets and equities on the open market. So they started purchasing things like treasury bills. I think in some cases they bought some amounts of securities as well. So a lot of basically money being injected into the marketplace. And we can see here, so between March 2009 and 2010, okay, so the Fed did purchase some debt from some of the larger banks. They purchased failing mortgage-backed securities and long-term treasury debt. So this basically means that the government injected a massive amount of capital into the economy in order to keep it afloat. And before this, they were basically doing nothing. So paying attention to this green box here, this was right around the time where the Federal Reserve began injecting money basically into the economy. And again, we could see exactly what happened, right? When policy makes a material change to reverse whatever fundamental condition is causing the bear market, that's when the bear market ends, right? The bear market doesn't end because we make it to support. The bear market doesn't end because we set up a bull flag or the EMAs cross, or we form a wedge, or we get one good headline. Bear markets end when whatever fundamental condition that caused them changes or improves. That is the only reason a bear market has ever ended, and that is the only reason a bear market will continue to end in the future. Let's look at one last example from 2022. This one was probably recent in a lot of everybody's hearts, and I think we could probably all relate or at least understand what happened during this specific period. So let's talk about the fundamental conditions of this one. The first one was, generally speaking, there were high oil prices, rising interest rates, rising inflation, and a rising dollar, right? And I think every single one of us knows what was happening during this period, right? Interest rates hit about 5.25% during this period, or 5.5% from the Fed. We all know that mortgages hit around 7%. We all know that CPI inflation hit about 9.1 or 9.3% at its peak in, what was it? Let's just look at this. I have this up. It hit 9.1% at its peak in June 2022. So fundamentally, the market was kind of teetering on the edge, or the economy was kind of teetering on the edge of what looked like a recession. The consumer looked weak. There was a lot of inflation that was basically increasing month over month with no end in sight. Um, and yeah, I mean, I think I don't need to explain it too much. I think we all kind of know what happened over the last few years. So let's talk about how this bear market ended up getting resolved. Well, first of all, the Federal Reserve was able to get control over inflation, right? The Federal Reserve raised interest rates to a point where inflation began showing progress. And by progress, we saw decreases in inflation to the downside. And not only a single decrease month over month, but a sustained decrease in inflation over multiple periods. Also, this was kind of a little bit more of a less important piece, but there was some continued stimulus of the economy, right? There was the infrastructure bill that passed Congress. There was a CHIPS Act. So there was still money being injected into the economy. The United States was issuing debt in order to make that happen. So we were pushing money into businesses to help keep the economy stimulated. And by increasing the amount of money in the economy, we're helping businesses and ultimately increasing shareholder returns and profits. So let's take a look at this. Let's see. Okay. So this represents where CPI peaked and began showing a sustainable decline. So just to show you guys the chart, because I have it up now, we can see we peaked in terms of CPI in June of 2022 and basically continued declining from there all the way until about July or June of 2023. And looking back at the chart, we could see right around that same period where we started to really show a sustainable decline was also right around where the bear market ended. And let's just bring these two charts up next to each other. So let's go back to the weekly here and let's clean this up since this is a more recent example, easy for us to talk about. So June of 2022 was where inflation peaked. So this is, let's mark out June of 2022. So this is where inflation peaked, right about here. And let's see, July of 2022 and August were basically the first 2 months where we saw a decline in inflation. So we could see we got a little bit of a rally out of the market there, but ultimately wasn't sustained. But really by October, November, December, after we got that kind of 6 months of a sustained decline in inflation and showing that the Fed was truly committed to their mandate of decreasing inflation, this was when the market ultimately bottomed. So again, the timing wasn't perfect, right? Just because we saw that 1 month of data showing inflation dropped, that wasn't enough for investors to go all in and say, you know, we're good, we don't feel the risk anymore, right? This is a very common trend. There needs to be sustained information that proves that the fundamental reason that the bear market started is no longer relevant, right? And this changes from the type of bear market, like for example, COVID, there was just so much uncertainty. And once that uncertainty started to fade away a little bit and stimulus started being injected into the economy, didn't really matter anymore. Tariffs, again, is going to be kind of a binary event more than likely. I would assume the majority of them would probably get either rolled off at the same time or something would change to all of them at the same time. I would doubt that we would roll off countries on all, at least tariffs on all these small countries and random countries one at a time. It just doesn't make sense to me, but who knows, maybe that'll happen. So that was basically the ending of the bear market of really 2022 to 2024. And again, right, in the last three examples that we've covered, I cannot stress this enough. There was no bottom until the fundamental reason that caused the bear market changed, right? 73 was inflation. 2008 was basically banks going bankrupt and a recession. 2022 was all inflation, right? And each one of those bear markets only bottomed when the conditions that caused those events were either no longer relevant or they seemed to be under control to enough of the market participants for them to feel confident about investing again. Does that make sense to everybody so far? I know we kind of blew through those examples, and I think I misspoke on a couple of them, which probably created some confusing. But any questions or comments so far? You guys are also free to unmute your mic if you like. All right, we got a little bit more to talk about. All right. So the 2025 bear market, I think every single one of us knows the main fundamental driver of this one. It is all tariffs. There's literally no other reason for this bear market outside of tariffs. That is the problem. And Attilio said this great in some of his mastermind lectures, but I'll just reiterate, um, being completely apolitical, the tariffs are basically in control by one person, right? It's all the president of the United States, whether you like it or not. That's where the tariffs are coming from, right? It's not something that Congress voted on. So we're going to have to look to the president for any kind of change in sentiment or change in tariffs. That would be basically the primary driver of a bottom in this bear market. So just as to quick highlight this, I just pulled this directly from the New York Times. Honestly, I don't even know how accurate this is, but I do know that it does effectively illustrate kind of what's going on. So we can see all these new tariffs being placed on all of these countries. So we can see the EU is going to have an extra 20% tariff. China is going to have an extra 34. Japan at an extra 24. And why does this matter, right? Well, fundamentally, again, it all ties back to the consumer and businesses, right? As a consumer, would you rather buy an iPhone that's $1,000 or an iPhone that's $1,400, right? Because if the price of an iPhone goes up by 34% or 40% and it's made in China, well, now it's going to cost $400 more, right? So you're probably less likely to purchase that product. And lo and behold, Apple's a publicly traded company. And what happens when a publicly traded company makes less revenue? Well, typically that means they make less profit. And the primary thing that shareholders care about is top line and bottom line, revenue and profit, right? How much money are they making? Because that's what matters to the shareholders. And obviously that's a big oversimplification. There's more that matters, but keeping things simple. And same thing goes for businesses, right? What happens for automakers that are importing their vehicles from, maybe South Korea or Japan, right? Maybe like your Honda or your, what is it, Kia that's in South Korea? I don't even know. All of a sudden, those automobiles just increased by basically 25% in price, right? A lot of us probably don't want to buy new cars now due to the price. Think about how many more people are not going to be as excited to buy cars when the price goes up by another 25%, right? So these tariffs definitely, no matter what side of the aisle that you're on, doesn't matter. They are going to make things more expensive. Doesn't matter who you ask. That's what tariffs do, right? And this was a pretty good study that I found previously done in 2018 that really summarizes well kind of the impacts of tariffs. And I'll post a link for you guys all to read through it. I personally haven't read through the whole thing. I just mostly noted the key findings here. This looks interesting. Anyway, so tariffs basically raise prices and reduce quantities of goods and services for U.S. businesses and consumers, which again, if prices go up and less quantities of goods and services, that means there's going to be, anyway, things are going to cost more. And then the other one that I wanted to highlight was the effects of each tariff are going to be lower GDP, wages, and employment in the long run. Tariffs also make the U.S. tax code less progressive because the increased burden generally falls the hardest on lower and middle income households. And I don't know who funded this. Maybe they had some kind of political agenda, but I thought, the summary was still very reasonable. Anyway, I thought they were interesting. Now, I will say, just being fully unbiased here, there definitely could be, maybe an upside to some of these tariffs, and that's something that we'll just have to wait and see. It could result in more manufacturing in the U.S. and more jobs, and that could be a big positive for the economy. So TBD on how this all plays out. I think most of us know basically all as good as each other. We really don't know what's going to happen. There's really no reason in predicting if tariffs are going to be good or bad or the other. It really doesn't matter, right? At least as far as the market goes, it doesn't matter what we think if tariffs are going to be good or bad. Doesn't matter if you voted for Trump or Biden or whoever else. It doesn't matter, right? All that matters, at least in terms of the market, is how the market continues to react to the policy that is currently in place, which are significant and large tariffs. And more than likely, the only time that will change is when tariffs are either reversed or the structure's changed or there's some significant benefits that are realized to these tariffs. Yeah, that's a good question from iPhone. Who pays the tariff, the buyer or the seller? Technically speaking, it's up to the seller to kind of determine how that's structured. There could be in some places where the sellers basically absorb some of the tariff cost and reduce their profit to try and maintain the amount of people that are still buying. So sometimes the burden could be split. And sometimes the burden could be all on the seller. or excuse me, the buyer. But I would say in general, the seller would never absorb all of the impact of tariffs. It's going to be either a combination of the buyer and the seller, or all the buyer that's forced to absorb the impact and increased price. And the way that I like to think about it is think about when prices increase now, right? Who deals with it, right? When gas prices go up, you're the one that pays the higher gas prices. The gas pump or gas station still makes however much profit they were making when it was $4 a gallon or $4.50 a gallon. They don't care. They're still going to mark it up however much they need to make money, right? That doesn't change. So that's a good question, though. All right. So before we go to the charts, wasn't the market severely overvalued prior to the mentions tariffs by Trump's? Yeah, I mean, there's no denying that there was definitely a lot of hot air in the market. There was a lot of kind of stimulus in the economy, right? A lot of debt that the United States was taking on in order to fund a lot. So yeah, there's no denying that there was a lot of excess money in the market. Again, that's a completely apolitical statement, right? There no doubt about it. No matter how you ask it or who you ask, if somebody's giving you a truthful answer, the United States was taking out large amounts of debt, and that was being used to stimulate the economy in multiple different ways. That is 100% reality, completely objective fact. So yes, there's definitely an argument that the market was overvalued, and still maybe is. Who really knows at this point? We have to see once we start to see some of these quarter one earnings that come out here soon. We'll start to know where companies start to change their guidance for the following years based on tariffs. So TB, right? But it's a great point. So again, just some kind of highlights here. Studying the past helps us prepare for the future, right? So studying these last few examples helps us realize that bear markets don't just happen randomly, right? They happen for a reason, and bear markets don't just end randomly. They happen for a reason. History rhymes, but it doesn't always repeat, right? So what that means is, for example, 73 and 2022, those bear markets definitely are very similar to each other. Now, they weren't the same, right? We didn't have the oil crisis and 15% interest rates, but the premise was reasonably similar. Again, or the last thing to mention is that always pay attention to the chart and the overall fundamentals, right? Your opinion, my opinion, everybody else's opinion literally doesn't matter. I could say tariffs are the best thing that's going to happen ever in the whole world and buy every stock because of it. And that doesn't matter, right? It doesn't matter if I think tariffs are good, if I think they're bad. All I can do is see that the market is reacting poorly to tariffs. So if I'm thinking objectively, I should continue to think that the market will continue to react poorly. The market will continue to stay in a downtrend until there is some kind of resolution on tariffs, whether they're canceled or there's a benefit to them or something that's realized. You have to be objective. You cannot just rely on your opinion, even if you did some detailed economic analysis and you figured out, you cracked the code, and you realize that these companies are going to benefit huge from tariffs, right? You could think that, and maybe that's true, and maybe you do find a unicorn or a diamond in the rough. But fundamentally speaking, the market won't bottom until it either has some hope that tariffs will either be good or end, or until they actually do. Yeah, and there definitely is some companies that are and have been holding up a little bit better during this whole event. Like, for example, some software focused companies, right? Software companies aren't selling a product, so tariffs don't matter as much to them. Essential services, like, for example, let's just take a quick look, like Home Depot, not doing as poorly, right? I mean, still looks pretty rough, but all things considered, people are probably going to keep improving their homes and going to Home Depot. Something like Costco, right? Costco is pretty well known for, generally speaking, having the best prices on everything. And, while they may or may not import some of their foods, they're holding up decently, right? Because people are probably still going to continue shopping. It was the same thing that we saw during COVID, right? Same exact thing. If you go back to COVID, which I can't right now for whatever reason, but if you go back to COVID, Costco held up pretty damn decent because people are going to keep buying food. People are going to keep buying shit at Costco. And it really doesn't matter, right? Oops, I still can't see that code. Yeah, so this was COVID basically for Costco. It was, wait, no, it's not. What am I saying? Wow, it was even less significant. This was COVID for Costco. As the market continues to hit new lows, let's see, wow, how much did Costco even drop? Costco didn't even hit a bear market because of COVID. Costco dropped 18% and then didn't hit any new lows while the market continued to hit lows. So yeah, there's definitely going to be some names that are affected less by tariffs. Um, yeah, that's the reality, right? And maybe even something like Walmart, probably not as effective, right? People are probably still going to keep going to Walmart. How does the USA get into debt? Is it like consumer debt? Is it like credit card debt or loans? It's a great question. Yeah, so basically, the way the US gets into debt is not specifically consumer debt or credit card debt, but you could think of the federal government as getting their own loans, we'll say. So the federal government says, okay, I'm going to get $1 trillion in tax revenue this quarter, and I want to spend $1.5 trillion this quarter on whatever, right? The federal government has a budget and they say this quarter I want to spend 500 billion on defense. I want to spend 100 trillion or 100 billion on education, and blah 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 blah. So the United States realizes that they have a $500 million deficit or $500 billion deficit for this quarter, right? So they need to find $500 billion. And the US doesn't have this big stockpile of cash that they just pull from every time that there's a deficit, right? They don't have that. What they can do, though, is they issue basically notes directly from the Treasury. And these notes pay some amount of interest, and they have different length periods. So they could be anywhere from like 1 month notes all the way up to 30-year notes. And what those notes represent is the Treasury is saying it's like an IOU. It's like the Treasury says, you give me $100 for this note. While you wait for me to give you back the $100, I'm going to give you, say, 1% in interest every year. So, for example, iPhone, I could say, all right, iPhone, I need $100 from you. In return, I'll give you $1 for the next 10 years, and then I'll give you back your whole $100. That's basically what the United States does. So they issue treasury bills. Those treasury bills have varying periods, and those periods come due, and we have to find ways to pay our debt and refinance and blah, 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 blah. Anyway, it's like they just have a big credit card that they just keep swiping. Lewis, can you explain why some people care about consumer sentiment? For example, extreme greed, extreme fear. Yeah, so extreme greed, extreme fear, that isn't as much about consumer sentiment, but rather it's more focused on actual market sentiment. And generally speaking, the reasons that people care about that is, there's the age-old term that buy when people are fearful and sell when people are greedy or something like that. So you can see that's like the fear greed index. This is at extreme fear. That's actually at a 4. This is kind of a wild reading. I haven't actually seen it this low in a long time. That's awesome. Well, not awesome, but it's interesting. So I wouldn't say that this is something that you should care too much about. It's just something that you should refer to, like in general. Yeah, it's not something that's really like a Bible. There's a couple different surveys such as this. Like this is the AAII sentiment survey. So this represents the amount of people that are bearish, basically. So we can see 61.9% of the market are bearish right now, which is the 1-year bearish high, and most people that have been bearish in the last year. We can look at the NAIM, which is again a group of investment managers. So we can see right now that investment managers have an exposure of about 50%. Generally speaking, when this number gets above 100, that means they're leveraged long. And right now they have about 50% cash in general. So anyway, I just kind of blew through that, but there's a lot of examples. Long story short, it's all just used to kind of see how the overall market is feeling. It's like a pulse check on the market and seeing where things are at. Generally speaking, when we see this kind of level of extreme fear, that's generally when we see the most aggressive bounces to the upside. In bear markets, that's when you see the most violent rallies. Bear markets are actually, yeah, that's awesome. Sorry, it's not that awesome. Actually, it's not good. I mean, yeah, it's not something for me to joke about. But anyway, bear markets are generally speaking where you see the most aggressive rallies. So, for example, we're in a bear market now, basically. And the SPY rallied 5% in 12 days. That's pretty significant, right? Generally speaking, the SPY doesn't do that. Over this period, over 77 days, it didn't do anything. And here it moved about 5%. So that was a big rally in between there. But generally speaking, we don't get those kind of rallies too frequently. So bear markets have the largest rallies. And even check this during COVID, right? This was midway through the COVID drop. And all of a sudden we rallied 10%. And you might be thinking, oh, the bottom's in. We rallied 10%. Only for us to drop basically another 30%. So long story short, bear markets have the most aggressive rallies, more aggressive than bull markets. And you can't let those suck you in. Just because the market starts moving higher doesn't mean the market's bottomed. And again, goes back to our prior point. In general, on bear markets, they will not end until the fundamental reason they started is resolved. I can't stress that enough. Even after the dump, the S&P's trailing 12-month PE is around 25, which is above its historical average of 15 or 16. Do I see us as returning to the historical average? That is an excellent question, BB. Honestly, I don't have an answer for you. At least I don't have an answer directly to that question. Um, yeah, that's not a metric that I personally track very closely, so I actually don't have an answer. It's a really good question. I think Tilio would probably be a better person to ask that question because he's more in tune with those specific metrics. The one thing that I will say is in terms of the levels that I'm looking for to the downside, well, not looking for necessarily, but just paying attention to, is this 480 spot. So this is the prior all-time highs on the S&P, and I drew a little bit of a zone. So right around from 470 to 480, a real important area there, as well as the 20% bear market level around 490. The next most important level to me is the 200 weekly moving average. You can see that during our last bear market, this was basically the dead bottom, and nothing good happens below the 200 weekly moving average. If we get below the 200 weekly, we are probably in a lot of trouble. So we don't want to see price get below there or stay below there, I should say. Yeah, right. Let's take a quick look at NVIDIA. Yeah, I mean, in general, it's close to a similar spot as the S&P, right? It's close to oops, I have these ugly, get those off there. So it's at a spot where you really got to start paying attention to it. Again, doesn't mean to just blindly get long, but starting to hold some of these prior highs back from, let's see, mid 2024. Definitely a much needed pullback and kind of cooling off in this name. And again, what I'm going to say in all these names is these sorts of pullbacks create opportunities for long-term investors, right? So while we don't know when this bear market is going to end, if you have been wanting to buy shares of something, if you have been wishing you bought shares of something, now is the time to start doing that. That doesn't mean sell your house and put it all into NVIDIA or Tesla. That does mean, if you want and you like a company and you feel like you should be buying it, start allocating a little bit of money to it. Buy a little bit here and there. Don't need to have a full position right now, but start making some purchases. Get the shopping cart out, right? Because in the long term, this will be an opportunity, right? This bear market is going to end no matter how long it takes or what it takes. It's going to end just like it always does. The market's going to go back to all-time highs, whether it's in 5 or 3 or 1 or 10 or 20 years. It's going to go back to all-time highs and it's going to surpass them. It always has. It always will. That's never going to change. So if you have a long enough time horizon where you could buy, say, $1,000 in shares in Tesla, and you can watch Tesla decline another 20, 30, 40% and continue to keep buying and not really care because it's a long-term investment, time for you to get to work and start putting some money to work. But you have to be putting money to use to work that you don't need, right? Like, for example, don't start putting your rent money into the stock market just because we dropped 20%, right? That's going to put you in a terrible position because if we drop more, which we absolutely can, we're in a downtrend, we're basically in a bear market. What has dropped more can definitely continue to go lower. You'll be in a bad spot. But if you have some money lying around that you want to put to work and you don't really care about or need in the short term, then I would definitely recommend to start to put that to work. But from a technical perspective, there's really not much I'm going to add. Yeah. We'll take a look at Tesla as well, but again, from a technical perspective, again, there's not probably much to add here. Obviously it's at a significant discount from a level standpoint. You got a pretty key one right around that 214, but it's currently holding below the weekly 200 moving average. That is not a good look. From a fundamental standpoint, this one's got some rumors of maybe Elon kind of stepping back from his role in the government, so that could be a positive. But tariffs probably won't help Tesla. Tesla makes cars in the United States that they sell in the United States, but their parts are sourced from everywhere. I mean, Taiwan and Mexico and everywhere, right? Their parts don't just come from the US, they just fabricate everything in the US and put it all together. But they got suppliers all over the place. So again, right, in general, the market likely will not be bottomed until we see a resolution on tariffs. All right. The last thing that I wanted to cover is just a quick review of the S&P. I think now more than ever, get some levels on the chart and just start watching how price behaves relative to them. The most important levels in this area right now are 490.58 and a 480. These are prior all-time highs in that bear market threshold. Those are going to be the number one and number two levels that matter right now. If we break those levels, I mean, we're definitely probably going to head lower down to the weekly 200. But a continued hold actually could be a little bit of a positive and maybe could set us up for a short-term move higher. But for now, I want to be very clear. Any bounce that you try and get long for, you should understand that it is strictly a short-term trade. You should not be in the business of trying to predict or call the bottom of a bear market. It's not a good idea, right? Be focused and remember that any bounce should be treated as a short-term one. You're trading against the trend. The trend is definitely down. So you're trading against that. So just keep that in mind as you're trading throughout the next few weeks, right? The big purpose of this lecture was to educate you all on what a bear market is, why we're currently basically in a bear market, and how to protect yourself a little bit, right? Again, this is not a normal trading environment. This is not the same as trading over the last 1 year, right? Options contracts are triple the price. Volatility is triple the quadruple. The market is so much more emotional and news driven than basically the last 3 years. So anyway, I really wanted to just take the time for this lecture to highlight all that for you guys. I hate to see people just getting absolutely wrecked when I know they shouldn't be, and people are just making decisions that they shouldn't be. So this isn't a market to be YOLOing. Just either trade small or study. In my opinion, right? Size down. You don't need to be a hero. This isn't going to be a market environment where you're going to make your millions. Just take it easy. Spend the time learning. Spend the time learning on how to trade bear markets, and all that's done with sizing down and being a little bit more strategic with the trades that you're taking, right? You don't need to be in a position every second of the day, and you do need to be paying attention to the news and the data. All right, everybody? Short the VIX. Yeah, I mean, that's an interesting question. I mean, realistically, the VIX will head back to 15 at some point. Honestly, I haven't looked at options on the VIX in a long time, so I really don't know how they behave. Um, Yeah, I don't know if it's not a trade that I personally would take, but I mean the VIX will go back to 15. It will go back to 35 like it already did. I mean, we just look at the history of the VIX. It doesn't stay up here for long typically in terms of volatility. Maybe, for a couple weeks we'll see it up here, but probably no more than that. But it does have room higher, right? I mean, it does have room around to the 80s if it wanted to get there. But the VIX, generally speaking, doesn't spend very much time around this area. And there's a higher probability than not that it continues to make headway back south. But it doesn't mean that it'll end the bear market, but still, it could spend a few weeks up here as well. I mean, we can see during COVID, it spent basically 4 or 5 weeks up in this elevated area, and that definitely can happen again. Not to say that it will. But yeah, let's just look at the VIX contracts really quick. I have no idea how they trade these days. They're expensive. Yeah, I have no idea how these trade, honestly. I am suspicious of it. I would probably prefer getting something like I don't even know what's inverse VIX these days. UVXY maybe? Literally don't know. Nope, not this. VXX, and that's 3x leveraged normal VIX. Let me see. Uh, an inverse VIX. Asphalt. Heard that one before. Yeah, I mean, this is one maybe you could, dip your toes in if you're trying to short volatility. But again, just be mindful that, you know, this could absolutely continue to get blown out. If the VIX goes to 80, this is going to get stomped on. But I mean, it's definitely a trade that will more than likely pay with some time. Like, I think realistically, there's probably no way in 6 weeks that the VIX is still this high. Um, so it's a trade that can definitely work. I don't hate it necessarily. You have a friend that traded during the 2008 bear market. He bought in heavy on Citigroup shares when it was below $1, banking on the government bailing out the banks, and he got paid. Yeah, I mean that's definitely a little bit of a different bear market than this one, right? What you could, if you wanted to take a similar kind of, it's basically a lotto trade, right? You could find whatever companies are the most impacted by tariffs and try and buy some of those if you think that tariffs are going to get reversed. Um, Yeah, Joseph, that makes sense. Yeah, VIX. I've never really seen VIX contracts pay well. I've traded them. I've traded VIX calls like once in my life, and I think I just scalped them. But that's kind of why I was staying away from them. I would take Rivers' advice on that. He definitely knows more than me on how the VIX contracts behave. I'm not super educated on those, to be honest. Yeah, do I know what's going on with TLT? It doesn't usually follow the market. Um, yeah, it's an interesting question. So, TLT, generally speaking, inverses the market. As the market moves higher, that means the demand for bonds drops because of the fact that money's flowing into equities, which is why the market's moving higher. And TLT represents bonds, right? So, if this bond ETF TLT is increasing, that means more people are buying bonds. If it's decreasing, that means less people are buying bonds. So the fact that it's following the market isn't unheard of. It does usually go opposite of the market, and I'm sure we could do some back tests and see how it's behaved during prior bear markets. Um, this is also a 20-year Treasury bond. So if we looked at maybe like the 1 year and the 2 year, I would assume maybe those would be behaving a little bit differently. But yeah, I mean, fundamentally, I can't specifically explain why this is following the market lower. I actually don't know the answer to that question, to be honest with you. I could probably think of something to say, but I don't know the true answer, if there even is one. My best guess would be just a general flight to cash, right? Not only are investors not interested in United States bonds, but they don't even want to be they don't want to be in stocks or bonds, right? They just want cash right now, and that could be the problem. But I can't say for sure. It's a very good question, R. All right, everybody. Well, that's going to do it for us today. As always, really appreciate you guys' time tonight. This was a fun one, and I hope you guys learned something and hopefully are a little bit more cautious if you weren't already being cautious in the markets. It's a great time to protect yourself. It's a great time to study and learn. It's a terrible time to be full porting. It's a terrible time to be YOLOing. Just take a step back, take a chill pill, and focus on the environment. All right, everybody. Appreciate your time. I will see you guys all in the next one. Be safe out there, everybody.